Ladies, gentlemen, welcome back to the channel. And honestly, for some people, this is going to be the most important video you have watched in a very long time. Because in today's video, we're going to be discussing the seasonal weakness that's coming, what could happen in markets, and how to respond to it. Now, this is going to make the difference in you having a great year or a fucking change your life kind of year or having a bad year. Okay. And I think we should talk about the crash we had back in April. And even, my experience in the markets. Started investing back in really 2016, 2017 was when I first started. Towards like the end of 2017 is when I started to take it very serious and started developing into the investor that I am today. Okay. But it's important during certain markets and times in markets that you understand how to excel. Okay. September is going to be an opportunity for some. It's going to be not great for others. And it doesn't necessarily mean that September is going to be like a crazy bad month. As we know, seasonals are just not good in September. And we'll talk about this more in just a few moments. September is by far the worst month, dating all the way back to 1950. Okay. It's the worst month over the past 10 years. It's the worst month over the past 20 years. Like, it's bad. Okay. Now, bad on a historical basis is negative like 1%. As an average, that's pretty rough, meaning it could be a lot worse than that, might not be as bad as that. But long story short, September in and of itself is not going to destroy your portfolio in my view. Like, we're not going to have a 20% crash in September. But your choices and decisions you make this month could be something that either make or break you from a return perspective. And we'll talk about that in just a moment. Hit the like button and subscribe to the channel. Help push this video out to as many people as possible that want to hear this. Because honestly, like, this is probably not going to be a video that gets a lot of likes or views. And it's not really designed to be that way. If I can help anyone understand what we're about to go through and the best course of action to take this month and save them, it was well worth it. Even one person. So that is what we're going to do here in today's episode. Okay, so I want to explain this very concisely. As I've talked about just a few moments ago, September is a bad month. It does not mean it's going to be a month that destroys your portfolio. It might be down 0.5%. It might be down 5%. Okay? Is that going to destroy your portfolio? No. The biggest reason why people do not get insanely rich in the markets on average, like active investors, why passive investing tends to be better, it's not because, like, the more information you gain, the worse, like, you should do. Like in theory, if you're someone that actively participates in markets, keeps up with markets, is trying to pick out the best stocks, you should outperform. The reason people don't is themselves. Okay? You are your worst enemy in markets. Yes, you heard that right. It's not Trump. It's not tariffs. It's not what the Fed is doing this year. It's you. Emotions. See, it's funny that the evolution of Wall Street from, the late 1800s until 2025, not a lot has changed in terms of emotions. Okay. Now, back in 1880, when there was one problem, one company would go bankrupt. Yeah, it would, like, ruin a lot of sentiment. It could cause multi-year slumps. And I guess that part of it has changed. Like, businesses come and go. Some do well, some do not do well. But it doesn't take down the entire markets like it used to for years. Okay. But on a single person level and on a broader kind of basis, emotions run rampant in markets. That's because money is one of the most important things in life. Yes, it's again, for anyone that rebukes at that, family, love, your sense of purpose are all more important than money. But unfortunately, those things do not pay the bills. They do not keep you off the streets, okay? They do not, do a lot of the things that you may love to do. They don't drive your car. They don't put gas in the tank, okay? So money is a very important topic. And people kind of go wild when things are bad. They think they're going to be bad for longer than they are going to be. They think they're worse than they are. When things are good, people tend to think they're going to be good for longer than they're going to be and better than they think they're going to be, okay? Here's the fact of the matter, okay? With a weak September and some choppy data recently, we have a lot of economic data coming out this week. Let me give you a brief rundown. We're not going to go over expectations here in this video, but this is a short week. So you have Tuesday, Wednesday, Thursday, Friday. Tuesday, you have ISM manufacturing PMIs, secondary data that comes out along with that. On Wednesday, you have JOLTS job openings, the Fed Beige Book, but a couple Fed speakers. On Thursday, ADP employment change, Challenger job cuts, the balance of trade, initial jobless claims, ISM services PMIs. On Friday, you have non-farm payrolls, the unemployment rate. Okay, this is all going to feed into expectations for Fed cuts, but most importantly, it's going to feed into expectations around the economy. We've seen on Friday that everyone seemed to miss. The two most important metrics, in my view, for the economy came in really, really, really good. Okay, the Atlanta Fed GDP Now tracker went from 2.2% expected Q3 GDP to 3.5%. Mainly because real personal consumption expenditures growth went from positive 2.2% to positive 2.3%. And second quarter real gross private domestic investment growth went from 4.4% to 4.1%. Okay, these are the metrics that really matter. The Bureau of Labor Statistics is not very good. Okay, so for an example, if we have a negative jobs report on Friday, Wall Street's going to panic. Mix that with a weak September seasonal. People are going to be talking about recession again. Okay? Like the unemployment rate misses by 1/10, goes up to 4.4%. Oh, yeah, recession, it's coming. That's what you're going to hear. Okay, I actually think the jobs report could be better than expected, but I'm just trying to make a point here. Throughout the month of September, bad news is really going to be amplified. And people's emotions are going to amplify this. Like, why do you think Wall Street is so bad at their jobs? Why do you think analysts are so bad at their jobs? It's not because a lot of the times they're like stupid, okay, which there's definitely a fair bit of that. Most of the time it's because they have heavy bias and they're highly emotional. The best investors are the ones that don't give a fuck. Don't care what happens. Okay? Now, I'm not saying to not care, but there's some things you need to understand that make a lot of what happens in markets just noise. Okay? First things first, you have to understand that the markets, two things matter: earnings and the multiple. Okay? We all know this. Okay? What affects earnings? Well, the economy. Is it good or bad? Well, simply put, the data that we get these days is not very good. Okay? So earnings are the best thing that we can look at because that is like audited, real time, how is the economy doing? Earnings were expected to grow 4% last quarter. They grew 11%. It was the strongest earnings season we've seen in a very long time. Earnings don't like collapse the following quarter, right? That's just not how the economy works. You don't go from having great earnings to shit earnings just like that. There's got to be a catalyst. There's got to be something that happens, okay? We'll talk about that in just a moment. But you have the multiple. The multiple is really a factor of interest rates, about sentiment, all of that, okay? Now, we'll get into it in just a moment. But towards the end of this year, we're going to start getting rate cuts. I think the economy is going to improve for the lowest quartile, consumers that have been struggling from inflation, right? Especially into 2026. Like, no tax on tips, no tax on overtime could save people thousands of dollars. But they don't get it until tax time. Like March, April, May 2026. So that should really be an accelerant to push us forward, economically speaking, in 2026. Okay. But I think inflation is going to come down. There's going to be more certainty around trade deals, around geopolitical tensions, hopefully dying down, and this focus on AI that's not going away anytime soon. So, long story short, I think next year is going to be great. I think October, November, December could set up to be some of maybe the best 3 months we've had in a very long time. Okay, I expect a very strong end of the year rally. But in September, emotions are going to be high. The bias is on Wall Street to sell stocks, to assume the worst case scenario. And you're going to hear, again, if the data's weak, recession's going to come about. And this could have an impact on markets that's quite large. Like, as I talked about in the last video, you could see the S&P fall about 4%, 4.5% from in September if we start to get weakening economic data. But you have to understand this. It doesn't matter, okay? Earnings do not collapse for no reason, okay? That's number one. But number two, the economy is so diversified, we don't really go into recessions anymore, okay? Because why? People don't really panic the way they used to in the 1900s because you have a central bank that'll bail people out. Companies are resilient, XYZ. But really what it comes down to is consumers don't change their behaviors very easily. You have to see like massive layoffs, and we're not there, okay? Yes, there's been some weird things with immigration in the past couple of years. That's going to make the job numbers weird, but is that leading to massive layoffs? No. I think personally, this economy is pretty status quo. I don't think it's really changed a lot in the past 6 months. Okay. So that's important. You need to understand, no matter what the data comes in as, it's likely not going to change what happens with the economy. Or the end of the year thesis, where I think markets are going to have an aggressive rally, or 2026 being a strong year. I don't give a rat's ass how the jobs report comes out, to be honest with you. Like, could it short-term move markets? Of course. Am I investing for the short term? No. I really don't give a rat's ass because it's not going to be the thing that causes a recession, right? Here's the important part. If there is something that is meaningful, that changes things, that could cause a recession, you need to pay attention to that. So it's not being stoic to the sense of, oh, I'm bulletproof, nothing can happen, nothing can affect my thesis, right? That's not what I'm saying here. What I'm saying is a lot of the shit that could move markets in September does not matter at all. The economic data does not matter, okay? Like, you need a catalyst to give you a recession. If a trade embargo with China was not enough to give us a recession, the jobs report really doesn't matter, right? Like let's be honest there. Okay. Now, I'm not a financial advisor, not a financial planner. We're going to look at some of my returns this year and some of the expectations, okay, in just a moment. But that's the fact, okay? Now, from my perspective, if like trade negotiations fell through with China and Trump issued new tariffs on China, that would be something that would obviously really negatively impact the markets. It would also bear a lot more attention from myself. That's something you need to watch a lot more closely, okay? That would be something that is material, that could change earnings, that could change the economy, that could cause a recession. At this point, though, it seems highly unlikely that anything in September is going to be enough to spark a recession, right? We just don't really have recessions these days because the economy is so large. It's like trying to turn a little boat. Okay, yeah, we're going to use this analogy. If you're in a floaty in the ocean or the beach, you can turn pretty easily in that thing. If you're in a fishing boat, you can turn pretty easily in a fishing boat. Do a 360 spin. If you're in a cruise ship, it takes a while, okay? That's like the economy. Back in the 1800s, it was like you were in a floaty, right? Small economy, not very diverse, very heavily concentrated in certain areas yourself, right? You were a boat in the early 1900s. Still, pretty easy to turn, heavily concentrated, small. Now, today, the economy is a damn cruise ship. It doesn't change much unless there is a big catalyst, like it hits an iceberg and sinks, okay? Yikes. Probably shouldn't have went there. Either way, okay? Hopefully you get the idea. Now, the risk is, and what a lot of people's mistake will be, is they will see a bad jobs report potentially this Friday and say, oh crap, recession's here, sell everything. What's the risk in that? The risk in that is stocks fall sharply, you get bearish, you sell, you miss your opportunity to stay vested in markets. And then what happens? You recover, okay? I think the beginning of this year is a great example to this, and this portfolio is a testament to this, okay? Started off the year January 2nd. Portfolio year to date was up 1.27%. January 6th, it was up 16.5%. Fell back down to 2.3%. Was bobbing 10, 15% year to date. By February 19th, 18th, it was up 40% year to date. Oh yeah, that didn't last. Okay. Portfolio went negative year to date around early March, down 6% year to date, down 12.5% by mid-March. By April 21st, April 7th, April 21st, you're down like 16, 17% year to date in this portfolio. What happened? If I would have freaked out, panicked, that would have been that. Maybe I'd be buying in now, but the recovery, right? Next thing you know, portfolio by July 23rd is up 94.5% year to date. Sure, it gets a little choppy over the next couple of months. By August 21st, portfolio is up only 57.5% year to date. And now, portfolio is up 80.57% year to date. Okay, if you look at the account value on this, net deposits this year, $19,100. But year to date, portfolio is up $56,000. Gain is about $37,000. Okay, I point this out because this was a prime example of a moment in which a lot of people panicked, but staying the course paid dividends. Now, again, you're going to see very volatile price action in September. One data set is going to make a lot of people draw wildly bearish conclusions. But it's not like I highly doubt you're going to have a catalyst for a recession. Highly doubt that. Okay. Now, we're outperforming the S&P by like 11, 12x what the S&P is doing this year. We're outperforming 98% of hedge funds and institutions. So I think I'm quite qualified to speak on this. The experience and track record, I think, qualifies me to speak on this. But what we're doing over here, this is actually the trading community portfolio. So all the trades and investing in that community is done in this portfolio. Other portfolios as well, but this is the one that I like to track it with because honestly, I just like the way that Public lays it out. Like you can look at account values, returns. There's a link down below in the description of this video. You can look at income, like your dividends, right? Q2 2025, I got $170 in dividends. Q3 got $65. You can look at it just breaks it down really easy. There is a link in the description of this video if you guys want to join via the Public link. But honestly, you just sign up for yourself if you don't want to use that link. Like, it doesn't matter. But what we're doing over here is going out finding small cap AI stocks before Wall Street does. Whether that's IONQ, Applied Digital, Nebius, went really heavy in Nebius earlier in the year. And that was obviously great. Not in just this portfolio, in other portfolios as well. Should have put every dollar I own into these stocks, but hey, live and you learn. But that's the strategy. We're going out finding small cap AI stocks, investing in those before Wall Street does. And it's the stocks are far and few between, but when you find these opportunities, they're so slam dunkish. It's like a no-brainer. So even though this portfolio is very volatile, I'm like, I understand the companies I'm investing in. I understand how the economy works on a very deep macro and micro level. So I don't give a F what happens, right? I'm stoic in that sense that I understand what's going on, what we're doing. It doesn't matter what happens, especially in September. Like I expect things to be bad. If they're not as bad, great, pleasant surprise. But if they are bad or terrible, great, I'm expecting it. And again, this is really a testament to do not let your emotions dictate your outlook, okay? And I think the basis of why I'm so stoic is because I understand how the economy works. I understand that you don't go into recessions these days unless you have catalyst. And unless we get news that is recession-worthy catalyst-like, if I can explain it like that, there's no reason to give a crap what happens to markets. So for many people, the best move in September may just be to not even look at your portfolio at all if you are a super emotional person, okay? If you can handle looking at your portfolio, and we do get some deals and discounts in September, we will be taking advantage of those. I mean, this week alone, I have a stock that I have over $100,000 invested in multiple different portfolios that has a big catalyst this week. It could be really good or really bad. I think it's going to be really good, but yeah, it like doesn't matter. No, doesn't matter. I understand the mission. So check it out, link down below in the description of this video if you would like to. Okay, so hopefully you're getting the point of this video by now. Like, obviously the point should be clear. Unless there is a catalyst that could cause a recession, earnings don't collapse. We're setting up in a way where multiples should be able to expand. Maybe not on the headline S&P, the multiples pretty expanded there, but in other areas like small cap AI stocks, like the broader markets that are trading at below their historical average multiple, okay? I think there's going to be a pretty aggressive rally in October, November, and December. It could be one of the best 3-month periods in a long time. And I think for the reasons I've discussed on this channel many times now, tax policies, consumer getting better, real estate that starts to move again, things like that. 2026 is going to be a great year as well. So September, don't let your emotions get the best of you. I don't care if September is down 10%. Price is price, and price really only has to do with emotions, right? Between earnings seasons, it's all emotions. That's all it is. And it's hard to tell how strong emotions are going to be in the worst month, essentially in history for the markets. But I can probably say they're not going to be very bullish. Okay. And Don't waste your opportunity by getting emotional, selling in September, and then trying to buy back in. Like, that's going to kill your return. Make your decision now. Do you sell out and live with that and have no regrets? Or do you let it ride? So come check it out. Link down below in the description of this video if you want to join the trading community. Ladies and gentlemen, again, for Tesla specifically, like it's pretty obvious. All of what I've said in this video is just amplified in Tesla. That's simple. If it's really bad, it's going to be even worse for Tesla because of the high beta. But as we've talked about for Tesla specifically, Tesla's year is most likely next year. Like, the big bang in Tesla is 2026 in my view. And I think that starts in the last 3 months of this year. I think Tesla could actually close out this year over $500 a share. I think the next, the last 3 months are going to be pretty damn exciting for Tesla to the upside. So that is it. Ladies and gentlemen, have a great rest of your day. And I will see you in the next one.